What will happen when there is an increase in money supply? The most obvious impact of the bloated Fed balance sheet is inflation. But the official numbers say that inflation is not taking place. The resolution of this contradiction is that you are linking the Fed balance sheet with the money supply. They are related, but the first does not automatically cause the second. The Fed has been buying assets as part of quantitative easing, QE, a Keynesian experiment in managing both interest rates and the money supply. This shows up in the graphs you cited, particularly if you look at the 10-year period. But this has not caused an increase in the money supply because banks are not stepping up lending in response. This disconnect comes from two sources. First, banks got gun-shy about lending when the government blamed them for the mortgage meltdown even though they were following HUD guidance on the loans. This made them uneasy about lending even though they had the reserves to make loans. Second, business got gun-shy about borrowing. They were not looking to take on debt following the meltdown in 2008, and I'm not sure they are really over that yet. So, the common perception that the Fed prints money is a gross oversimplification. It is true if there is a demand for credit. If there is no demand or willingness to lend, the Fed can loosen the reins all they want and there still will not be an increase in the money supply. This is actually a very complicated question. There are two things that are imperative to consider when trying to understand the implications of increasing the money supply. 1. Any changes in economic productivity are automatically priced into the economy. What this means is that any new money created will never represent any real economic productivity. 2. You cannot just increase the money supply. In order to inject newly created money into the economy, it must either be lent or spent. Because money that it lent or spent into the economy is not uniformly distributed, this causes economic productivity to be redirected from things that the market actually wants and can afford into things that it cannot and otherwise would not. This is called malinvestment. The U.S. Federal Reserve lends money into the economy. This has additional consequences that we'll come back to later. Basically though, the Fed lends to financial institutions, and what they do with that money depends on the general economic and political environment. Basically, by redirecting economic productivity away from things the market wants and can afford and into things that it can't, asset bubbles are created which inevitably come crashing down once economic reality sets in. We're about to see that again in 2018 or early 2019 at the latest. Now, back to the thing about lending. Because the Fed lends the money into existence, the money has to be paid back and ultimately destroyed. When that happens, purchasing power gets sucked out of the economy from the people who have to pay the loans back. In practice, the aforementioned people are the lower and middle classes, who get stuck with all the mortgages and student loan debts and so on. Not only that, but all the interest collected from those loans does not get destroyed. Instead, it goes to bank moguls and other wealthy individuals. If you consider that the money they used to collect that interest was simply fabricated out of thin air, it becomes plainly obvious that the entire process is a very elaborate scam that artificially redistributes wealth upwards, causing untold economic damage along the way.